Welcome back to Fundamental Analysis. We're going to now move from the personal financial statement into corporate financial statements. And this is what many people think about when they say, I'm going to learn about stocks. I'm going to learn about how to look at a real estate deal or a stock deal, the investments, right? We're getting into the investments. I'll just say as we hop in, nothing will ever be more important than your personal financial statement. And what we do now is we make these corporate financial statements part of what you do personally. And so we want to have good quality investments. We want to have investments that are smart. We want to have investments that have reasons for owning them, and a good logic and a good justification to owning it. And after we get done with that, we'll hop into sovereign. So just like the personal fundamental analysis, a fundamental analysis for a corporation is that same idea. And if I took 20 people and I had them all take a physical, and I got 20 people with blood pressure and blood sugar and cholesterol and reflux, and I just looked at these fundamental things with 20 different people, with that information, if I were an insurance company, I might say, here's the person who's likely to live the longest. Now, they could get in an auto accident tomorrow, right? Or they could come up with cancer tomorrow. But that's not what it's about. Again, I'm going to reemphasize time and time again that while we're going to make a forecast, the idea of having this feeling, and the reason I tune into this often is when I was first taught fundamental analysis and technical analysis, I had this misunderstanding. I didn't understand it very well. I felt like I had to find an investment that was going to work, guaranteed to work, and that I just have this feeling that, hey, I had this erroneous idea that guys like Buffett and guys that are really smart, they just always know the outcome and they never make mistakes. And they're really not mistakes. Look, if I'm an insurance company and I were to do a physical on 20 different people, and I chose the people who had the best numbers here to give the lowest insurance rates to, I did it right. And it's not a mistake if one of them suddenly gets cancer, something we couldn't foresee. That's where we use risk management. So just as this would help me find 20 of the most healthy people, if I run a fundamental analysis, it should be more and more clear to say, God, you know, it really does make sense that before I invest in a stock, that the company I'm investing in should be making some money, and they should have control of their expenses. And I should look at the assets and liabilities. What do they have? What do they owe? How much cash is flowing in, and what is the equity in this company? You know, what's it really worth? And so, you know, when I started this program, I said, hey, as you get into this, you'll be nodding your head saying, wow, you know, this really does make basic sense. Why would I put my money in something that I didn't look at or analyze? And so this is going to help you make better choices than if you didn't. And it's fantastic. So let's talk a little bit about price and value. And let's think about these things not as synonyms, but as very, very different things, because they are. Often when they say, you know, what's the value of this thing, someone will quote the price. You know, what's this house worth? Well, this house would sell for such and such. So one way to think about this is when there's an exchange of cash for something, the price has to do with the cash, and the value has to do with what the cash pays for. So if you're the one handing over the cash, cash is what you paid and value is what you receive. And great investors learn how to make really solid exchanges. You don't need to have a win-lose here. You can have a win-win here. You don't need to exploit other people here. As a matter of fact, you know, I like the idea of giving more value than for what was, you know, paid for whatever it was. That's a great way to make money come faster, because if you start giving out more value than money that you take, people will start sending their money to you faster. Let me say that again. If you start as a business owner giving out value that is greater than the price you make people pay, that will accelerate the rate at which people will pay you. And so that's a great lesson to think of, is if I'm going to pay something, and let's say that this was a stock right here, right? Then before I pay, let me take a look at what I'm about to receive. And that's very difficult to do with a real estate project or a business or a commodity or stock without knowing how to do a fundamental analysis. It might be a plus, it might be not a plus, but I enjoy metaphor. I enjoy teaching. It seems to help people. If we understand something in one context and we say, I got it, then it's easier to transfer it into an investing context. So because I played a little basketball, I'm a big fan. We might use a basketball idea here. Is you have LeBron James, who's an older player in the league, and you have Zion, who's a younger player in the league. So when these guys, go to negotiate their contracts, you're saying, what do you pay this player? What's the price for this player? But what am I really going to get from this player? And the way this works is I'm going to say, well, if I look at LeBron, what's his current production? It's probably really, really high. And what's his potential for improvement? Well, it's probably a little bit lower potential for improvement because he's older, and you slow down when you're older. And so this would be LeBron, huge production maybe now, but less production, maybe later on for potential. With Zion, maybe some good production now, but probably a pretty big upside. So, we look at this, what they're doing now. If we looked at a stock, we might say, well, how much money do they earn now? Earn now, and then what might their growth potential be, in the future? That's how we might look at it. Well, the only way we can really look at that is do a fundamental analysis. So that'd be value. Okay, now price is going to be determined also when other people begin to make that judgment. And as everyone looks at this idea of current production potential, they'll all begin to bid on what they think that value is worth in terms of price, in terms of money. And so then the supply and demand starts, and that drives prices higher depending on how people feel about this value. So if we look at this same idea, how do we value a player? Well, we look at how much they produce and what they might produce in the future. Okay, well, how do we price a player? Well, what are other people willing to pay, right? And if we happen to have really good understanding of value, we might have a little insight here, because if we can find value that other people have missed, and that they're paying really high prices because they're caught up in a frenzy, or they're underpaying someone, this is where you go. There's a wonderful movie called Moneyball with Brad Pitt, and I'm not the biggest Brad Pitt fan, but it's about this very, very thing. Is here you have the Oakland A's, and they're struggling, and so they really took a step back and said, well, are we going to get into a price war for all these players, right? Are we going to get in a price war, or are we going to say, okay, what do we want? Well, we want runs, right? That's what we want. We want to purchase runs, not people. And so they looked at people that could produce runs, and in case they said, here's a guy that gets on base by getting walked a lot, so we'll pay more for him. And they found hidden value in these players. And I sincerely recommend you watch the movie Moneyball, because it helps you understand it's a great lesson in fundamental analysis in terms of price and value. So once you understand that in baseball, then maybe you come into the 4 pillars of investing. You say, okay, now I understand that in basketball and baseball, what I'm getting and what I'm paying for it. Okay, now let's look at stock. How do you value a stock? Well, we might do the same thing. What's the current production? And then what price, is trending? And so that makes up the first 2 pillars right there, is the value we're getting for the stock and the trending prices, because they are different things. So if you have to rewind this and go through it 2 or 3 times and watch the movie Moneyball, to kind of think of it. Okay, what am I really paying for? I want to play for runs, not a name or a player. I want to play for runs. That's a real cool way to look at it. Warren Buffett is possibly the most famous investor of our time. I think he's the best investor. I'm a huge fan. I loved the HBO documentary that he did about his life. That's a great one to watch, as well as these movies I'm telling you to learn from. Isn't that funny? I like to learn from movies instead of a classroom. And Warren Buffett, in that HBO documentary, it talks a little bit about his, not much, but a little bit about his mentor and teacher, who was Benjamin Graham. And Benjamin Graham really was about value investing. In other words, he says, we're going to study what we're getting here. We're really going to take the time to look at what they're doing now and what their potential could be. We're going to learn how to study value investing. And it says that what value investors do, and a great book by Benjamin Graham that I think still applies today, with electronic trading, maybe some people might argue that it's not relevant anymore. I believe it still is. Certainly high frequency and algorithmic and artificial intelligence trading machines have had some impact on this, but fundamentals will still matter. And so there's a great book called The Intelligent Investor. And when you look at the word intelligent, notice that it's intel, which means we're going to gather information. You know, the CIA is the Central Intelligence Agency. They have spies that go out and they gather intelligence, they gather information. So he has a book called The Intelligent Investor. And they look for securities where the prices don't match the value, because the prices are unjustifiably low based on what's inside the company. And so there isn't a universally way to accept this intrinsic worth, but most often, and it's absolutely the approach we use, it's estimated by looking by analyzing fundamentals, or if you reverse those two terms, fundamental analysis. And the value investors search for stocks that they believe are undervalued by the market. In other words, the supply and demand doesn't match it, or the stocks that are just not recognized, their value isn't recognized. And that's what Moneyball was about. That's what that movie Moneyball was about. Can the Oakland A's compete with the Boston Red Sox and the New York Yankees have 10 times the budget by finding players that other guys missed, that were valuable and underpaid, but if you put them together the right way, they could compete, you know, in a World Series situation. And so that's it. Most often it happens, and that's really why the very first pillar is about value. And I'm going to talk a lot more about this, but you know, and we'll get it when we talk about, you know, Munger from Berkshire Hathaway says, you know, if all you want to do here is shrewdly buy and sell pieces of paper and become wealthy, that's certainly something you can do. It's doable. You certainly, and many people do. That's what you know, algorithmic trading and AI is all about. But I very much love Warren Buffett's approach and Munger's approach to saying, look, we want to provide value to our customers. So when we buy a company, we take that very serious, that we're an owner of the company and that we're a person that provides value to the world. So that's why I enjoy, you know, owning companies. And again, a little disclaimer, don't just buy the companies I list. This is again for education, not recommendation. But one of the first stocks I ever bought with my sons and taught them to buy stock is I said, you know, what are some companies you'd be proud to be the boss of? What are some companies you feel that if you own them, you'd be giving value to customers? And they chose Disney and McDonald's as their first two stocks. And the reason is as customers, they enjoyed the Disney movies and the vacations to Disneyland, and they, for whatever reason, enjoy McDonald's, you know, nuggets. And so when they bought those stocks, they became an owner of those companies, and they had the opportunity to provide that value as an owner to other people. So we're not just shrewdly moving pieces of paper. It's very healthy to look at a stock as the same way you would real estate. The real estate that I own provides housing for families and individuals. And so I look at it the same way as owning stocks. Is when I own Coca-Cola, I'm providing beverages to people around the world as an owner of that company. It's very much like being in a syndication. We'll get into that here, but we ought to talk about it now. Is A syndication is simply when you take a larger property and you cut it up into pieces and have a whole bunch of investors put their money together to buy it. And so you might own 5% or 2% or 1% or whatever. You don't own the whole thing, but you're still an owner and you're still providing value to these people because it's yours. And that property is partially yours. You have ownership of it. And so that's important stuff. So that is the fundamental analysis idea of value investing. So there's a lot of lessons from history. I don't remember if I did this I think I might have done this in the very first version of Four Pillars and that we did years ago. It bears repeating. There's something called obsolescence risk that we'll talk about in the fourth pillar, risk management. And here we have a company that is in the same business. They're in the movie business. And so Netflix is about watching the TV, and Blockbuster's about watching the TV. One uses a streaming technology, one used to use a DVD technology. And the streaming technology overtook and made the DVD technology overvalued. There's people that will be taking this version of the four pillars, or young investors that will scratch their head at this and say, wait, you actually used to go to a store and you'd walk the aisles and pick up a DVD and rent it and have to take it back after you watch the movie? That's the silliest thing we've ever heard of. Just download it. And yet that's exactly what we did. That's exactly what we used to do. And so let's just do this. This will be fun. I'm going to go out of theater mode. We're going to take a look at some of these financial statements. Let's just go and begin here with Blockbuster Incorporated. And again, this is around 2010. They filed for 2009 on January 3rd, 2010. And so this is when we were able to receive this information. Now, a Form 10-K is what the Securities and Exchange Commission requires all publicly traded companies, all companies you can trade stock in on the exchanges, to publish a statement. To do this Form 10-K every single year. They actually have to do one every quarter as well, called a 10-Q. So the 10-Q happens quarterly, and this one happens annually. And what this is it's a chance for those guys to give investors information about their business. So when we talked about Warren Buffett being a student of Benjamin Graham and saying, let's dig in and see what we're buying. In a way, you're purchasing the financial statement, really. This financial statement tells you what the business is and what it looks like and what you're getting yourself into, what you're buying. And so as we search for value, we might see a stock that's that's low cost. Well, let's go in and see if we can find out why that might be. Why are investors not as interested in this stock? Or if a price is very, very high, we can say, well, why are they willing to pay so much for this stock? So the first thing as we scroll down here that you'll notice is risk factors. So let's open this in a new tab for risk factors. And it will say, here are the things that we see could cause us problems. So this form forces companies to say, look, this is what we can see within reason. And, this is where Enron failed, is, Enron had all kinds of problems and they did not put them in this statement, which is illegal. So it's a very exhaustive thing, because if a company were to have a problem, it can have lawsuit and problems, and they have to put their best foot forward. And if there's something ugly, they have to declare it. And so here are some of the risk factors that Blockbuster sees in their business, and there's a lot of them here, right here, tons of them.
One of them that I think is important to point out is the idea of their business strategy in terms of their operations. Let's find it right here. Here it is. We cannot predict the impact that the following may have on our business: new improved technologies or video formats, alternative methods of content delivery, changes in consumer behavior facilitated by these technologies or formats, and alternative methods of content delivery. They're talking about Netflix here, aren't they? They're saying, you know what? There's video on demand here. There is other ways to deliver the content. And if consumer behavior changes, which is very likely, there could be problems. And so, we compete generally for consumers' entertainment dollar and leisure time. And so this is about obsolescence risk, is what we would call this. In other words, if consumer behaviors change and newer technologies come out, our technology could be obsolete. And so they have to put this in black and white for everyone to see, saying this is what scares us as a business. This is what we think could give us some problems. So that's an interesting thing when you look at risk factors. Now, in part 2, there's financial data. And I said that the heart of a fundamental analysis is the financial statement. And so here we see item 8 is the financial statement. So this is very interesting. Notice if they're getting sued, they have to say things up here in legal proceedings. This stuff is really about accounting, right? This is a section is one of the most popular sections to look at. This is about the directors and how much everyone's paid and how much insider ownership there is. These are the things that are very interesting to read for an investor. And if you go to Yahoo Finance or Google Finance or CBS Market Watch or any of these other companies, this is where they go to get the financial data to allow a person to do fundamentals. So you don't need to go straight to the Form 10K, but this is where it comes from. This is where the data comes from. Pretty cool stuff. So let's click on financial statements and open a new tab here. And brings us down to this part of the statement here in the middle, truly the heart. And we can take a look at their different stuff here. So here's some consolidated statements of operations. That's another word for the income statement, or the statement that comes in here. And you'll see we're going to learn about this, the income statement or the statement of operations. We're going to understand balance sheets and then the statements of cash flow. And those are the three parts to this that we are generally concerned with. So let's look at the operations. And right here they have 3 years we can look at, 2007, 2008, and 2009. And the reason we're going to look at 3 of them is that helps us see any trends that might be going on. So we're going to click on this. We'll go ahead and click on it. And we go down to what's called the bottom line. And the bottom line, if we can just scroll this down just a little bit, I don't know if I can do it where we can catch everything here. Yeah, we can. Barely. There we go. Right here we say, 08. This is really 07 up to January 6th of 08. This is really 08 up to January 4th of 09. And January 3rd, 2010 is today's statement that we're looking at here, or years ago. And so it's a great lesson of history, and we're going to do one that's a little more recent here. This is just such a clear-cut example. It's a great one to be your first one to look at and learn from. So right here we have this big thick line called the bottom line, and there's several words for this. There is profit. You could call it profit, which is revenues minus expenses. You could call it net income, which is the most popular. Income. You could call this earnings, which is also extremely popular. Earnings. And you could call it the bottom line. So just a little bit of financial vocabulary here. is those four things. Now notice I didn't put cash flow in here. Actually, cash flow is a little bit different. We're going to dive into it, but cash flow and profit are definitely not the same. We'll show you why. But this is the fun stuff. This is the part of financial education. This is the detail of jargon and literacy as far as understanding the vocabulary or the nomenclature of these financial statements. So basically, profit, net income, earnings, well, how much money did you make? What were your profits? What did you earn? What's your net income at the end of the day? What'd you bring in after all the expenses? What's the bottom line? Right? That's where the word the bottom line comes from. Often it's a figure of speech now. Hey, just give me the bottom line. When someone says, hey, just give me the bottom line, they're saying, look, I really don't care to go through every single one of these numbers. Okay, just tell me what the bottom line is, and then I know where we are. That's why that figure of speech is how it is. Give me the bottom line. Look, I don't care how we got here. Just give me the bottom line. And the bottom line is simply this. You are a stockholder. You are an owner of this business. So as an owner of this business, you can see how much your business lost. And here we have 3 years ago. This is in check this out. This is in millions. So they didn't lose $85. They lost $85 million. Then they lost $385 million. And then they lost $569 million. So if I were to draw a financial statement, okay, and if you paid attention to the patterns of cash flow, let's just put in income, let's put in expense, let's put in asset. We'll go ahead and write them out in this case, and we'll abbreviate liability if I can. We talked about how expenses are always going out, right? And they add and then over here we'll just say we have cash flow, but in this case we'll just call it profit, okay? And we'll explain the difference between cash flow and profit here in a bit. And then we'll have, equity. And what's interesting is obviously there's not enough income here, so we've pulled 100% of the income for expenses, and it wasn't enough. And so we also have, where's the money going to come from? It's either going to have to come from borrowed money or it's going to have to come from assets. And so we should expect to see, since this is a huge negative number, we have a deficit of $569 million. That's $500 million. $569 million. Well, we certainly didn't have that much revenue, right, to cover this where we have this deficit. So where's this $569 million going to go? Well, if it's the U.S. government, they'd borrow it, and then they'd print it. But this is a company, and people might not loan them $569 million. So my prediction is their asset column is dwindling, and this equity number is going to go down because they're probably taking stuff from here, liquidating it, and sending it in here. So we talked about that bankruptcy pattern, right? The first step is insolvency, right? And this is an hourglass. In other words, how long can these guys sustain this loss right here with asset money instead of new income, if that makes sense? And so this is where we see that first lesson that we had in this section of fundamentals of understanding how the cash is flowing, seeing that, hey, these guys are in trouble. I said earlier that you might have some epiphanies where you might say, wow, this is actually makes a lot of sense. This is, not like some people think, well, there's these guys on Wall Street that have these secret sauces that, they just have this data no one else has, and they have these insight. No, look, there's the bottom line. I mean, no matter how you slice this, the bottom line is they lost $569 million, and they've been losing. And see, this is a trend. This is getting worse, not better. And boy, you think, you look at this trend, you look at where they're going. Now a person starts to see a direction here. You read that risk factor and you say, okay, well, is technology going to get worse for Blockbuster? Our consumer behavior is going to say, you know what, this ease of downloading at Netflix is just too easy. And I feel so bad for Blockbuster. I think I'll go down to the video store and walk around. This is the point where the guys left in the video store a little weird, right? I mean, you're like, oh, these guys, who's hanging out at the video store anymore? So all of a sudden, a person might say, wow, this might be worth taking a short on, right? Now the good news is, as I said, you're never going to be 100% sure. Maybe Blockbuster, they got a huge brand, and maybe some big corporation says, you know what, that's a pretty good brand. If we put an influx of cash in here and started putting in online movies, maybe we could save them. So that's why you'd have to have an exit strategy. You'd have to have a risk management. But as it stands right now, we could make a decision to take a short position on here without guessing or going off a gut feeling. We say, look, we have data that says if things continue the way they are, this company is going to go bankrupt. If it continues, if this trend continues, they will go bankrupt, right? And so you can see a clear path of where they're headed. It is the risk management that deals with sudden change. So you can feel a level of comfort here knowing that you will never get to a point where you're going to have a guarantee that, oh yeah, guaranteed, this one's going up. As a consumer, a person who works at a job, their mindset is very much about a guarantee. How much will I get if I show up for work? Guaranteed. I don't want to show up and do a lot of work without guaranteeing that I'm going to get paid. Where an entrepreneur will start a business with no guarantee they'll never get paid. That's a really nice time to pause and think about the mindset of a person who craves guarantee and is fearful of any failure, and the mindset of investor and entrepreneur who says, well, I don't really need guarantees. I can adjust, I can deal with a failure. Most importantly, I can manage risk if things were to change. And so the entrepreneur starts a business on day one with no guarantee he or she will get paid. The employee comes demanding that they'll get paid, and that's why, that's why both groups of people wind up where they are. So you can feel a level of comfort in your education at this point saying, okay, I get it. I'm never going to get to this phantom place where I have a guarantee that when I buy the stock it goes up or when I short the stock it goes down. But what I can do is I can do what Warren Buffett does, and I can do what Charlie Munger does. They don't have any more numbers here than we do. It would be illegal if we ever found out that they, like Martha Stewart, got put in house arrest and had to wear an ankle bracelet because she had information from the inside that they didn't disclose to the general public. And if you get caught doing that, you go to prison, just like Martha did. And Warren Buffett's too rich to risk that, right? He's not going to risk that. And so these are the numbers that we get to see, and we get to interpret. And that's pretty clear that these guys are in trouble. It's pretty doggone clear that if things don't change, they could be in serious, serious trouble. So let's take a picture of this just so we have it, and so we can erase some of these things and move them around. And I'm just going to really take my time with this. I hope the critique I get is, Andy, you were too methodical, too slow, you repeated yourself too much. Because if I get one or two critiques like that, I'll get 2,000 or 3,000 thank yous on going slow. So that is really the bottom line. We can see that they lost money here on this bottom line. Let's go back up here. And now let's look at the consolidated balance sheets, and they're going to give us 1 year here from 09 to 10. And so we'll be able to compare 1 year. And here's the assets. Here's what they own, and here's what they owe. And we see a problem, a problem here as well. Right here we see liabilities from stockholder equity. We see assets. We see liabilities. And, well, we'll just stick with it right here. And then we see the equity, which is out here, the equity. And again, this is the shareholders' equity, and in this case, or deficit. And in this case, if you look at this right here, this is an interesting number. Is these numbers are not looking too good, right? Here we go from 2154 to 1583, and cumulative comprehensive losses and this total stockholder deficits. these numbers are not going the right direction, are they? They're getting smaller, they're getting weaker. So we see that the profits are going down, and it makes sense that equity would be falling because they're pulling money from assets, increasing liabilities to pay these expenses in this behemoth that is rough. Now, the reason this is such a fun thing to do is it's tough to see the up-and-comers. We'll talk about this later. When Steve Jobs started Apple, he was just one of millions of computer nerds tinkering his garage, and he would have been very hard to find. There was no 10K for Apple yet. There was no 10Q for Apple yet. They weren't even public yet. And to catch that on their first 10Q, there'd been no history to look at. There'd been no ideas to see. So it's very, very hard to see small things, and it's very, very easy to see big things. A mountain is easier to see than a grain of sand. And when something big happens and is destroyed, like a World Trade Center, boy, it's spectacular in its magnitude to just see something so huge just crumbling to the ground. And yet, you don't see the small little things like a leaf falling from a tree very often because they're small. And so one of the reasons this is exciting is think of GM, think of Delta Airlines. When Mitt Romney and Barack Obama were battling for the presidency, one of the hot topics in that debate was, should GM declare bankruptcy? And I think it was Romney that says, yeah, they should. And Obama says, oh, you want to be a job killer? And it really doesn't matter what side of the aisle you're on, they declared bankruptcy. And why were they talking about it? Why did they think there might be a problem? Well, they could see the financial statement. They could see the liability of all those union workers that were demanding pay in retirement, and they could see that they weren't selling enough cars to pay their workers. And the only way to do that was to convert them over into 401ks and to just deny those pensions, just welch on those pensions. And the only way you can break those promises is to declare bankruptcy and start over. And you get a new clean balance sheet, so to speak. So there are fascinating opportunities to the short side, and we'll talk about that in the cash flow pillar. But here, fundamentally, Blockbuster is obviously struggling right here. Now, if we go back, let's get rid of these two. If we now go to a different one, this is Netflix. Now, what's interesting is why you might look at the long side here and you say, well, why is Blockbuster struggling? And when you look at their risk factors, they kind of gave it to you. They said, well, if consumer behaviors change and if technologies change, then we ask the question, well, who has these new technologies? And the answer here is Netflix. These are the ones that killed Blockbuster, this and Apple TV and stuff like that. And so we have the exact same stuff, right here. And we can have their risk statements and read their risk factors, which were very, very similar. And one of the risk factors they listed here was also video on demand. And unlike Blockbuster, they said, what, maybe DVDs in the mail are beating DVDs on the shelf, but ultimately this is going to go to streaming. And they saw this and they reacted to it. And they said, we're going to get into the streaming business. And so it was. Well, they have their same type of stuff here, and we have financial statements right here on item 8 once again. And we can click on these and start to see their financial statements, which are interesting to look at right here. So here's their report from their accounting firm. Here's the balance sheet. Let's look at the statement of operations that's here for these 3 years first. And revenues are looking pretty good. Now this is in thousands, so that's $1 billion right there. That's pretty good. And we can see, down here, net income. And unlike Blockbuster, look at this. They go from 66 million, because this is in thousands, to 83 million to 115. So exactly the opposite trend of Blockbuster, right? And of course you can put this in per share or whatever you want to do. If we come up here to the financial statement, we see the stockholders' equity is positive and climbing, right? Significantly, they're putting more money away in assets, reducing liabilities, and the equity is going up. So we can see that what their financial statement is looking like. In fact, we probably ought to do this. We ought to draw what theirs looks like. Let's get this over here and put this over here like this, and let's draw theirs, right? And so here we look at income, and I'll go ahead and abbreviate if I can have that license, please. It makes it go a little faster. Assets and liabilities. We see that there's just money pouring in here, and that they're able to pay their expenses easily right here. And that means that this extra money right here can go from the income column instead of out the door. The extra money now can go in the asset column, and the net worth, or the equity, the shareholder equity, is going up, and the profits or earnings or net income is also going up. So here we have a positive number and a number that's growing, and plenty of income to feed the expense monster. And so the extra income can go buy more assets, which in turn might create more income. So a person might say, you know what, I like what I see here, and I don't have to tell you what would have happened if you'd have shorted Blockbuster in 2010 and bought Netflix in 2010. Those are huge opportunities, and they bear out in the fundamentals. So if a person invests in paper, you are the owner of a company. I like to harp on this because I think people get very emotional, and when emotion goes up, intelligence goes down. There's very powerful emotions, love and hate. These are called crimes of passion. And when people fall in love with something or despise something, their intelligence goes down. I was on a cruise with some of my real estate investing friends, and it was funny because the people who were gold experts, it was if gold was the only asset that could make you rich, and everything else was foolish because it wasn't real, and gold was the standard, and blah, 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 blah. And they even got so impassioned that they, said some things that were untrue. For example, ETFs or paper, they're worthless, all this stuff, which is simply funny. And I remember I was at dinner with one of these gold guys. He's a great guy. I don't want to bash him at all because he's really smart. He's a really good guy. He wouldn't have been on there if he wasn't. But I did. It was funny because he kind of smiled because I said, so if I buy a bunch of gold, like maybe I buy $5 or $6 million worth, I'm uncomfortable having $5 or $6 million of gold in my house. I mean, if you had $5 or $6 million in cash in a bank, you still might get robbed, and I don't have a security force at home. He says, "Oh no, Andy, you would have me store it in a vault for you, and I'd charge a little money, but I have a secure vault." And I go, "Well, how do I know the money's mine?" He says, "Well, I'd give you a receipt for it, and we'd have a thing." I go, "What's that printed on?" And he grinned because right there he knew. He's like, "Oh, crap, I've been trolled here. I've been had." And the fact of it is, a deed is a piece of paper that says you own property. A receipt is a piece of paper that says you own gold in the vault. A valet stub is a piece of paper that says you own a car in the lot. A claim check is a piece of paper that says you have a coat in the cloakroom. And a stock certificate is a piece of paper that says you own a piece of a company. All these things are real. The car in the lot is real. The valet stub is simply the paper that says it's yours. The house on the lot is real. The deed is simply the piece of paper that says it's yours. The coat in the cloakroom is yours. The claim check is simply a piece of paper that says it's yours. And the deed that has the real estate is yours. And the piece of paper that says you own some Coca-Cola, you're the owner of the company. And these are real companies with real valuable brands and real services and real value that they offer the consumer. And so, when you own a stock like Netflix or Blockbuster, you would treat it as if you owned a storefront. as if you owned a dry cleaners. A dry cleaners is going to look at their income, assets, and liabilities. A dentist who owns his own little dental, what are my customers? What are my assets? What are my liabilities? What was my income? And the only difference here, it's like a real estate syndication. You own part of it, not all of it. That's the only difference. And so if a person owns these assets, wouldn't it make sense to look at these numbers and make sure your business was running well? If not, you may sell your part of that business. If you had a dry cleaners and things were rough, you might say, what, I don't know if I want to get into this business. I think I'll see if anyone thinks they can run it better than me and wants to buy it. Happens all the time. And so if a person owns this, looking at these numbers quarterly would make sense. Doesn't happen in a 401k. The people that own a 401k, think about Munger and Buffett at Berkshire Hathaway. They're going to look at those numbers and demand reports every quarter from the companies they own wholly, like Fruit of the Loom, and the companies they own partially, like Coca-Cola. Those are very, 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 very important numbers to see where we're going with stuff. And you can see two very different stories very clearly. So hopefully this has been made simple. Now, people might delve into these little tiny numbers to try to spot a micro trend of hope or dismay within these. Well, this went up, but this went down type of stuff. Almost every one of these asset numbers went up. Every single one of them went up. Look at that. I don't see one that didn't go up here. See that as you look through these. So, pretty cool stuff. I don't mind that the liabilities actually went up because they might be using liabilities to create more assets. So as you learn how these numbers work, this gives you the lighting to see the health. It's like a checkup, isn't it? It's just like going to the doctor and saying, well, how's the heart pumping? Let's take a look. How's the body mass index going? Let's take a look. And these fundamentals help us understand these assets much, much, much better. So let's go back here into theater mode, and we were able to see some of the stuff. Let's pop out of theater mode, and I'll show you a little bit more recent. We won't go to the trouble of looking up the 10 Qs because we can get their information on Yahoo Finance or Google Finance or MarketWatch, or really any of hundreds of sources will look at this information and put it out there. But that's a real great lesson, and there's a couple reasons I use this lesson from history, many years ago, is it really sets up things that are even more recent. So one of the challenges of giving a person access over and over and over and over and over, and not having the expense of reteaching something every week, is that I'm going to put on video, and so after a while this becomes history. So here's a little bit more recent history, possibly, depending on when you're looking at this. Is here we have some things that are real, and I need to disclaim that this is an investment that I actually took a short position in. So I really go back to that disclaimer and saying, look, don't get excited about the money I made on this. Get excited about the process and learning. Just the fact that I'm using one that I made money on, that was a really nice trade, isn't to say, oh, I'm recommending you do this, because chances are, by the time you're watching this, either A, there's a chance this thing might have already gone bankrupt, or B, they saved the day and I had to have exited at some point. But as of it stands, right now, this was a really nice one here. So here on this side, we have GameStop. And this data, let's look at their income statement, and I'll go ahead and blow it up right here. This is from a website, and it's a little bit cleaner and easier to see than the scrolling through the 10 Qs. This is, again, there's any number of websites you can go to get this information. Really, really easy, really, really nice. And so here we have GameStop, and we come down, we say, well, what was the bottom line, right? What is the net income applicable to common shares? And here we can see 4 years of 16, 17, 18, and 19, 4 years of money. So here we have a positive See this? And then it gets smaller, and then it gets smaller, and then holy cow, they get decimated right here. Let me blow that up a little bit bigger so it might be a little easier to see. Let's just look at the bottom line. Look at this. And this is in, what is this in? This is numbers in thousands. So this is $402 million they're making just four short years ago. But all of a sudden they make $50 million less. You say, well, okay. But then they drop to a profit of $34 million. That's a tenth of what they used to make a year ago. That's a 90% reduction in their profits. But at least they were still making money, right? And then talk about a reversal. I mean, talk about in 4 years going from making $400 million to losing $673 million. That's their profit or loss. That's why they call it a profit and loss. The net income bottom line, that's a tragic trend. And we start to ask why. And if we were to look at GameStop, and we could look up their 10Qs, guess what their risk factors are? They're the same that Blockbuster had. Online gaming. Think of the, this is like history repeating itself. People say, how do you predict the future? Well, one is policy and demographics, but the other is predicting the future. Here it is in movies, and here it is in games, right? And I always kicked myself for not shorting Blockbuster. I always kicked myself, and I always said, you know what? If I ever see obsolescence risk again, I'm going to hop in, and if I'm wrong, I'll have an exit strategy. That's the beauty of the four pillars, is that fourth pillar allows you to invest and be wrong because you have plan Bs. You have a way to be wrong. Most people do fundamental analysis with the idea that I'm going to be so good at this data that I'm just going to be right all the time. Well, things change. Companies, when they're in dire straits, they're replacing CEOs, hiring smarter people. It's like a franchise in the NBA. They hire a new coach, and this guy maybe turns it around, right? And they innovate, and they figure it out. So you're never 100% sure that the fundamentals won't change next quarter. But I can tell you that it's hard to change things. It's hard to turn franchises around. It's hard to get a losing team and turn into a winning team. And you can really learn a lot about this by looking at your own financial statement and those of your friends or what you think they might be. Because if you see a guy that is struggling or a girl that is struggling financially, it's hard to turn that stuff around. They're in that bad situation for a reason. Here's a great quote. It's hard to solve a problem with the same mind that created it. Let me say that again. It's hard to solve a problem with the same mind that created it. So to change the mind, you can do two things. You can swap out who's boss, or a person gets educated. In other words, if you're listening to this and your self-concept is that you're not doing as well as you could have done, well, the mind that you have now has created your own situation at whatever level it is. So to improve the situation, we have the choice to improve our mind or swap out CEOs. Well, in my life, I've actually done that a couple of times. I've done it both ways. I've applied myself to learn new things and gotten better. But there's other things, like in my business, I run very, very little of my business, and I went and partnered with a mind, and I said, look, you're better at so much of this than I am. You're just smarter than I am. And so I was willing to say, look, I'd rather be in partnerships with smarter people than try to run the whole show myself and take 100% of profits. I'd rather have 50% of a huge pie than none of a gigantic pie, or a smaller pie. And so that's important to do. So, when you see this before, you say, Blockbuster, streaming movies, DVD games. And you look at this, you say, well, Tencent, which this is the company that owns the Fortnite, a big chunk of Fortnite anyway. Not all of it, but they own a lot of Fortnite. Downloadable type of stuff. And then you got going in the retail. If we look at their balance sheet, and we come down to net tangible assets, we're seeing some problems as well. Down here, we look at, this is the shareholders' equity, and we look at total shareholders' equity, and we can see it diminishing from here, down here. Now we're in trouble here. So we see some things here that I said, you know what? Let's do a technical analysis on GameStop and let's get it out. On the other side, you see this company in Asia that owns a little bit of Fortnite here. They're doing pretty well down here. 28, 41, 71, 78 in net income. That's pretty cool numbers on their income statement. They're growing, whereas GameStop in the same space is dying. If we look at their balance sheet, let's bring that to the front so we can expand it up. Nice and big for us. We look at their balance sheet, we can see 104, 132, 210, 259. So we're seeing growth in both the balance sheet of what this company owns and what they're worth, and the amount of money they're making. And you can see this often reflected in a stock price and get a good idea. It's hard to stop a moving train. Whether it's moving north or wherever it's south, it's juggernaut. Try to get in Amazon's way. It's tough. Doesn't mean that you can't have big behemoths, the train stop and change direction. And by doing a fundamental analysis, we get to see a lot of these things. So a lot of fun. A lot of fun to look at this, and we'll possibly, as we get into technical analysis, maybe shorting, we'll look at GameStop as an example of I've got two positions. Just for disclosure, is I bought put options opportunistically on GameStop, and I also am short the stock in a joint account that I trade with some of my trading buddies and some of the people that teach for us at the Cashflow Academy. Every Monday we have a joint account where we trade together, and we get together and say, hey, what are we going to do? And part of that process is I need to come to the table in that meeting with trading ideas. And so my trading ideas from the meeting and for those come from fundamental and technical analysis, these first two pillars of the four pillars of investing. And this is really how it's done on a basic level. Now, can you get deeper into technicals? Yes, you can. There's so many different metrics beyond just the income statement that come out of these things, and we'll begin to delve into those as well. It's really, really fun to do, for sure. Now, if you, what we're going to do is we're going to take a break. I like to keep these sessions to about an hour. And so we've hit that hour mark, and so we're pretty close to it, coming up on it. So I'm not going to give you homework between these two sessions, but if you wanted to, you could look up some 10Ks. You just Google 10K, SEC filing, and the year of some of the stocks, and that might be a nice homework assignment. I'm not give it formally. But when we come back in the next session, we're going to start to look at some deeper metrics and start diving deeper into the financial statement and see what more we can learn about value, so we can understand if what we pay makes us happy with the exchange of what we get. And it's very difficult to be a consumer as opposed to an investor, because a consumer is very, very obsessed with what they pay. They have very little understanding of what they get. Most of the time, a consumer is paying for something that costs less than what the guy to make. They're paying retail instead of wholesale. And so as a entrepreneur, you want to pay wholesale and offer that value for retail. And the key is to create value with less money, right? Something that you might have taken $10 materials and labor, but when the materials and labor are combined, it's worth $15 or $20 or $30. And that's something consumers don't really think about very much. They just want the blue jeans. And it's interesting. You take some blue jeans, you take some raw materials, you take some people maybe in China that'll work cheap, and then you throw a cool brand that's popular on those jeans, and the value you're now offering people in satisfaction and in someone saying, oh, those jeans are so awesome, and pretty soon people say that's worth hundreds of dollars to me, where they might have cost you just a few dollars to build. So as an investor, we really want to get cognizant of what did it cost to build, what's it doing, what's the value. What am I really going to get here? if I'm the one paying the price. What am I really going to get if I'm going to pay a retail price for a stock, or am I really paying wholesale? So we're going to get into some of these metrics. We've got a lot to cover. So I hope you're enjoying this first pillar of fundamental analysis. And when you're ready, let's hop into the next section together.